You're such an asshole!
Greetings, lieutenants and economists. The old captain here. I wanted to do this outside to show that I'm relaxing. I'm chilling out. I'm in Nevada somewhere. They got construction going on over there. And you're all texting me in front because I just got internet reception. And I'm like, okay, got my camera. So let's talk about the stock market crashing. In the great wise words of the great Matt Baldoni, everybody just calm the fuck down. And the reason you need to calm the fuck down, although regular readers, regular viewers already know the way I'm going with this, is for you normies and conformists out there who are just freaking out thinking it's bad that the stock market is collapsing. You have to realize that the stock market collapsing is a good thing. You want the stock market to collapse. Because when you do the numbers, and I did the numbers for my book, Poor Rich's Retirement, there's only 15%, not of the whole population, only 15% of the baby boomers have adequately saved for retirement. That means roughly 95% of the people do not have enough money invested through their 401ks or IRAs in the stock market. That means, if any of you actually care to be fiscally responsible, I know that's anti-American, but that means the vast majority of you need to acquire more stocks and bonds, more securities, more financial instruments to adequately save for retirement. And even though, oh my God, I mean, you sheep think the stock market is the economy, which it's not. Oh my God, it's going down. Oh my God, it's bad. Oh, I hate Trump, or I hate Bush, or I hate Obama. What you have to do is view the stock market as anything else you'd like to buy. You guys all get excited, you girls particularly, when Kohl's has a 50% off sale. They always have a 50% off sale. You guys, you never pay full price at Kohl's, but they got you girls tricked into thinking, like, it's 50% off. So I'll just cash in my husband's IRA and grab his credit card and buy $10,000 worth of crap I'll never use. But you get excited when there's a sale. You boys out there, when you go to GameStop or Use It Again video games or whatever they're calling it now, you get excited when a $60 game you could buy for half off. You get excited when they lower the price of Xbox and PlayStation. You get excited when the price of gas goes down. You get excited when the heat bill goes down. You all get excited when your expenses go down, except the stock market. And it doesn't make any sense. It doesn't make any sense because it's not in your interest for the majority of you. If you're a baby boomer who adequately saved up for retirement, and you're retiring tomorrow, I'm terribly sorry, it's bad timing, but for the vast majority of you, you want the stock market crashing down to 1, ideally 0.00001. You want stocks as cheap as possible, because then you could buy them on the cheap, and then there's much more room for capital gains. There's much more room for price appreciation. Now, the real issue is, Aaron, well, how do you know if the stock market's overvalued or undervalued? Well, let's talk about one simple measure. Just go talk about one simple measure. It's called the dividend yield. See, you sheep, you morons think, well, why do you invest in a stock? Because the price will go up. You ever ask yourself, why would the price go up? Nah, that requires you study finance, learn a little bit about economics and valuation techniques. But when you invest in something just because you think it's going to go up, that's speculation. That's not an investment. And there is a difference. I'm not pulling these words out of my ass. There is a key difference between investing and speculation. Investing is, I invest $10,000 in an asset, a stock, a bond, savings account, rental property, and it generates a monthly, quarterly, or annual income. I make $200 on my bond. That's a 2% rate of return on $10,000. I make $2,000 a year in rent. That's a 20% rate of return on rental income. I get a dividend of $500. That's a 5% rate of return on $10,000. In other words, you take your money, you invest it into an asset that then over the course of its life will generate more than the $10,000, $100,000, or whatever you invested into it. We don't even do that with stocks now. Stocks, if you look at their earnings and their dividends, what they actually generate in a cash rate of return to you, do you know what the dividends are? Everyone focuses on earnings. Don't focus on earnings. Want to why? You don't get earnings. They say, well, it's profits. Its earnings per share was $5 a share. You don't get to see that $5. You never get to see that $5. The corporation, the company keeps some of it. It's called retained earnings. All the shareholder ever receives, all that gives a share of stock value, all of it, is from dividends. And if you look at the average dividend today, well, 3 days ago, 4 days ago, your average stock In the United States, the S&P 500 paid 1.7%. That don't even beat inflation. You fork over $100 and you could expect to get $1.70 in dividends. You're better off paying off your student loans. You're better off paying off your credit cards. You're better off paying off your mortgage, even with the mortgage interest deduction, right? Because it's a higher rate of return, higher cash flow. But see, again, you sheep don't focus on that. You don't focus on cash flow. You don't look at dividend yields. You don't look at price to earnings. I buy now at 100 because it magically goes up 200. How typical spoiled brat American. Not World War II American, modern day pussy American. So when if you actually care about the fundamental value of a stock, you got to look at what kind of rate of return am I getting. Now, in the past, on average, going back to 1871, since this is the longest we've had a record of being kept, American stocks have on average paid a dividend of 5% a year. Now, it's very volatile. At the height of the Great Depression, it was up to, I think, 14%. That was a high dividend. You get a 14% rate of return every year. And it's the lowest now it's ever been. It's the lowest it's ever been now at 1.7%. Maybe it's up to 2% because the stock market shaved a little bit of its value off. But if you're going to use historical values of 5%, and this bears out in other measures like price to earnings ratio and price to cash flow, the stock market has to crash by more than half before I'd even think about investing in it. By more than half. If we're going to use from its peak, it would have to drop by about 60% to get that even to be average value at 5% rate of return. Now, I don't know about you, but if you want to play the game, well, I invest in it now because it goes up in more value later, yay! You can do that. But if you're smart and you actually want to say, okay, well, what value does this stock generate? What kind of income, what kind of cash flow does it generate? You better start looking at dividends. You can look at earnings too. I'd be happy if you looked at earnings. But you got to start looking at what kind of rate of return am I actually getting in cash? Because I got news for you. No matter how much the economy and baby boomers who didn't save up enough for it, and the rest of you are depending on your 401ks and your IRAs and your pensions, it ain't worth a 1.7% dividend yield. You and I and everybody have way better things to do with our money than invest in a stock market that only pays you a 1.7% rate of return. You could, again, debts right there. Everyone asks me, what should I do with money? What should I do? Like, pay off your debts. It's risk-free. It generates at least a 4% rate of return on your mortgage. Your car loans are up at 10%. Your student loans at 7%. Your credit cards, if you're really particularly stupid, it's up to 25%. Pay off your freaking debts. That's going to help your cash flow, right? And then only after you have your mortgage paid off, then maybe start thinking about investing in a 401k or an IRA, right? Unless the stock market actually magically crashes by half, which would be spectacular. It would be awesome. Then I might start thinking about investing in stocks. But in the meantime, because I'm smart, and I just don't do it, my HR person said to invest in the index fund because a 401k is a good thing. Okay, I'll grant you the match. Okay, you should invest because of the match. But you don't have to invest in stocks, you just contribute to your 401k. But because I'm smart and self-respecting, basically, I don't get my tits in a sling over the stock market dropping a little bit. I'm cheering it on. I want 5% because that's what I can get by paying off debts. Hell, that's what I can get for lending to individuals that I trust with a lower rate of risk. So that is the key lesson. People have been texting me, oh my God, what do you think about the stock market? This is what I think about the stock market. This is what I think. It's not what I think. It's what it is. You guys should be cheering on the demise of the stock market. You should be cheering it on. You want that thing to crash. Look, do you want gas to be a nickel a gallon? Would you like gas to be a nickel a gallon? Well, then you should cheer for the stock market, the Dow Jones, to drop down to about 500. Not by 500, to 500. And then then you youngin' generations, oh, Trump and everyone's out to get us. Then you might actually have a buying opportunity. Then you might actually have the opportunity to invest. But until that point in time comes, please read Paul Richards' Retirement. Please read Paul Richards' Retirement. That's the most poignant and opportune book to read right now. In the meantime, though, focus on your personal finances. Pay off your debts and fuck the stock market. It's not worth it. It's not worth maybe it's at 2% now because, oh my God, it went down 1,000. That thing has got to crash to below 13,000 before old Claremeister is even going to think about investing in it. And I suggest, if you don't understand it, you get my other book, Bachelor Pad Economics. We talk about finance and economics there. Read that too. But if you actually care, if you actually want to retire, adequately, not be a baby boomer working till you're 75 or 80, you might want to start learning and getting yourself educated about retirement planning and the financial markets. So start with start with Poor Richard's Retirement, then move on to Bachelor Pad Economics. We'll see you guys later. Toodles.